Hi folks, welcome to another episode of Who Said What. I'm your host Krishna, and for those of you who are new here, let me quickly set up some context for what this show is about. See, the idea is that I'll pick the most interesting and juiciest comments from business leaders, fund managers and the likes and contextualize things around them. Now, some of these names might not be familiar, but trust me, they're influential people and what they say matters a lot because of their experience and background. So I'll make sure to bring a mix. Some names you'll know, some you'll discover, and hopefully it'll give you a wide and useful perspective. For all the sources mentioned in this video, don't forget to check out our newsletter. The link is in the description below. With that out of the way, let me get started. Last quarter, Blinkit's management spoke about what they called a structural shift in their business. They were moving from a marketplace model where other sellers list and sell on the platform to an inventory-led model where Blinkit owns what it sells. The CFO of the company, Akshant Goyal, had said that most of our business will move to inventory ownership and margin accretion should happen in that time frame. The thing is, once you own the stock, you don't just earn a commission anymore. You earn the full spread between the buying price and the selling price. Now think about it. If Blinkit buys Maggi, say for all its operations across India, how much cheaper could it get? Meanwhile, they could also maintain product quality, reduce stockouts, and maybe even improve overall customer experience. Now, all of this could turn into more profits and greater competitive advantage. But there's another side to this. The moment you start owning stock, you also start holding cash in that stock. Every stock that sits in the warehouse is money that's already been paid out but not yet earned back. This is what you would call working capital. In the last quarter, Akshant, the CFO, had said that this would increase. At the full scale, they expected roughly 18 days of working capital or about 5% of net order value. But the company also made a point that not all inventory-heavy models are the same. The way Blinkit holds and moves stock is very different from how a supermarket does it. On the last con call, when an analyst compared Blinkit to DMart, Albinder explained why that comparison doesn't really hold. A retailer like DMart carries big, slow-moving categories, general merchandise, home goods, electronics, items that can sit on shelves for weeks. Blinkit, on the other hand, deals mostly in groceries and daily use items that move much faster. Stock comes in and goes out several times a week. Now, because of that speed, the amount of inventory Blinkit needs to keep at any given time is far smaller. So yes, working capital rises when Blinkit owns the inventory, but it's still lighter than a traditional retailer's because the stock turns over quickly. The faster the product moves, the less cash stays stuck in it. Now this quarter, that shift is visible in the numbers. About 80% of Blinkit sales now come from its own inventory. And with that, working capital has started to build up. The company now holds roughly 12 days of sales worth of stock, which is about 2,000 crores of cash inside the system, most of it in the QC business. Now that's the cost of control. When Blinkit adds a new category or opens a new warehouse, it also locks up more cash and goods that haven't been sold yet. Earlier, when the platform was a marketplace, that inventory sat on someone else's balance sheet. Now it sits on theirs. And while this change was meant to help with margins, the improvement hasn't showed up yet. In the latest shareholder, management admits while absolute losses decreased, the reduction in loss or margin expansion was below expectations. Now that line says a lot. The company had expected margins to expand faster, but chose to stay aggressive instead. Marketing spends were up about 4 times year on year. They opened new stores, built new capacity, and focused on winning more market share. In other words, instead of letting the efficiency gains from owning inventory flow straight into profits, they used that headroom to grow faster. Now in theory, the new model should make each order slightly more profitable over time because Blinkit now controls what it buys, how it prices, and how quickly it moves stock. But that improvement isn't visible yet. The short-term picture still looks flat because the company is using those gains to fund growth. And that's what this transition really looks like when you zoom in. The accounting change lands first. The day you start buying inventory, cash goes out. The benefits, which is steadier supply, better prices, happier customers, take longer to build. For a while, the business looks heavier before it starts looking more profitable. Albinder in the shareholder letter even says, if you have to choose between high quality sustainable growth and a short-term sacrifice of margins, we are in a position to choose the former given our strong balance sheet. In an interview with CNBC TV 18, Rajiv Bajaj said, I'm quite shocked with what unfolded at KTM in the last 1 to 2 years, and that corporate greed is the single biggest reason for corporate demise. Now, that's a bold statement, especially from someone like him. If you're unaware of why he said this, just sit tight. Let me explain what's going on. Bajaj Auto isn't just KTM's Indian distributor. It's also been the company's manufacturing and equity partner for a long time. Through a joint holding company with the CEO of KTM, Bajaj owns about 49% of KTM's parent group, Peer Mobility. In India, KTM lives inside Bajaj's pro biking division, the same one that runs Triumph. It's not Bajaj's biggest business by revenue, but it's important. It brings technology, exports, and a bit of global share. Last quarter, Bajaj sold around 26,000 KTMs and Triumphs in India, about 20% more than a year ago, and crucially restarted KTM exports that had been frozen for months. Now that frozen period is where the real story begins. Over 2023 and 2024, KTM's parent group started running out of cash. They had grown a little too fast. Each expansion was built on borrowed money, and when interest rates were near zero, that debt barely mattered. But once inflation hit and rates rose, it was quite brutal. After the Ukraine war, energy prices went crazy, labor got expensive, and raw materials stayed high. KTM was always proud of building their bikes in Austria, but suddenly they are competing with Indian and Chinese manufacturers who can make the same quality bikes for way cheaper. And on the demand side, the post-pandemic motorcycle rush was fading. Dealers had unsold inventory, customers were tightening up, and cash stopped coming in. By the end of 2024, KTM couldn't meet its debt payments. It entered insolvency protection in Austria, a court-supervised process where creditors decide how to keep the company alive. By early 2025, the Austrian government gave KTM a choice: either raise new funds to pay creditors or face liquidation. Now the number on the table was roughly 600 million euros, but no European bank wanted to touch it. Investors were wary. KTM's management was being accused by creditors led by a US hedge fund of designing a rescue plan that protected shareholders more than lenders. It was messy, public, and political. At that point, Bajaj was still a minority shareholder watching from the sidelines. But staying out wasn't really an option. KTM collapsing would have hurt Bajaj directly. It would mean supply disruptions, brand damage, and the loss of a partner it had spent years building with. So, Bajaj stepped in through a mix of loans and convertible instruments worth about 800 million euros. Bajaj arranged the cash KTM needed to meet its obligation. That money allowed KTM to pay creditors, get the court's approval, and formally exit insolvency in June 2025. But this wasn't charity. In return, Bajaj secured the right to take control. Once European regulators finish clearing the takeover, Bajaj Auto will become the majority owner of KTM's parent company. On Bajaj Auto's last earnings call, the CFO laid out how the crisis unfolded.
You might recall that when we last spoke, we had mentioned that we suspended exports to the KTM business through quarter 4, and that was fundamentally because we had anticipated a risk on our receivables through the pendency of the restructuring process. With that having been resolved in May, we resumed exports, and that in turn has helped both the exports performance and margin delivery.
He also said,
and therefore, the insolvency court in Austria, through its orders of 16th of June 2025, confirmed the restructuring plan that was proposed by KTM. And therefore, the entire restructuring proceedings now have been concluded and the business is back in many ways outside of that legal process. The orders are binding and no further appeals can be made against them. Having been through that process, we have therefore progressed substantially on seeking regulatory approvals, essentially from 4 fronts: from the Austrian Takeover Commission, the Austrian and the EU Foreign Investment Control, the EU Foreign Subsidies Control and Merger Control Authorities across 6 countries, all of which should hopefully be done in a couple of months. We've already received approvals from the Investment Authority and 3 of the 6 markets in which merger controls have been filed. And we expect to be able to conclude the rest of them all going well over the next couple of months. Upon successful completion of the regulatory approvals, we plan therefore to move to a control position and exercise the call options, and then start to work very closely and constructively to restore financial discipline and reposition the business for sustainable value creation and growth.
Now that phrase, restore financial discipline, quietly sums up the whole story. It's an acknowledgement that KTM's problem weren't just about the economy, they were about the decisions. Now that's it for this episode. See you in the next one. Now some of these names might not be familiar, but trust me, they are influential people and what they say matters a lot because of their experience and background. So yes, working capital rises when battery khatam ho raha hai isme. Now some of these names might not be familiar. But trust me, they are influential.